Very good afternoon, my dear loving students. So I am Asim Bagchi. I am working in a CBSE school since 26 years as a PGT accounts. So today I will share with a very important topic in accountancy in class 12 standard, that is accounting for share capital. So please you look at the board. I am writing this accounting for share capital. So today we will discuss this topic. So share capital, first of all we try to clear the meaning of share. What do you mean by share? The capital of the company is divided into smaller parts. Each part is called a share. The share capital of a company of the shares are divided into smaller denomination. It is in the form of like rupees 2 per share, say 5, 10, 50, 100 and so on. So now we need to know what do you mean by share. Share means the share capital of a company which include stock. So according to section 2, subsection 84 of the Companies Act 2013, a share means the share capital of the company which include stock is called as share. So these shares are classified as two ways. So now you try to understand the types of shares. Types of shares. So it is two types. One is preference share and another one is equity share. So now we will discuss what do you mean by preference share. Preference share are those shareholders, those who have the preferential right to get the fixed rate of dividend before anybody else or before the equity shareholder. So the preference shareholder, they will get the fixed rate of dividend before anybody else to get the dividend. They are called as preference shareholder. And furthermore, the preference shareholder, they are having the preferential right to get back their amount of investment at the time of winding up of the company before the equity shareholder. So these types of preference share is called as preference shareholder, and these preference shareholder are classified as cumulative preference shareholder, non-cumulative preference shareholder, participating preference shareholder, non-participating preference shareholder, then convertible preference shareholder, non-convertible preference shareholder, okay, redeemable preference shareholder and irredeemable preference shareholder. That means there are 8 classification, okay. And then you move on equity share. So equity shareholder, they will get the dividend after paying all the outsider parties, after fulfillment the claimants of the other parties, then the equity shareholder, they are going to get the dividend, and the amount of dividend is not fixed, and the amount of dividend absolutely depends on the amount of the disposable profit or amount of the residual profit after paying interest to the debenture holders or the long-term borrowings, after paying corporate tax to the government, after paying dividend to the preference shareholder, after outsider claimants, then whatever the residue profit is there, that will is available for the equity shareholder. And the company, they usually not to distribute all the residue profit as a dividend which made available to the equity shareholder. They usually kept a certain amount in the form of retained earnings, which is considered as reserve to meet the unforeseen future event, and thereafter whatever the amount left, that will be available for the dividend to the equity shareholder. So that means the amount of the dividend of the equity shareholder is absolutely depends on the amount of the residue profit. If the company having a huge amount of residue profit after keeping a certain amount of the retained earnings in the form of general reserve, and then the equity shareholder is going to get the huge amount of dividend. So that means the amount of the dividend is depends on the residue profit, and it is absolutely the appropriation of profit. You know the meaning of appropriation of profit? The appropriation of profit means if the company is having profit, then only the company will declare the dividend to the equity shareholder as well as also preference shareholder. Okay, and these preferred equity shareholder, they are the actual owner of the company. They can interfere in the company affairs. They can having the right regarding the property of the company. They are having the right to get the bonus when the company is having a huge accumulated profit, and the company can usually declare the bonus to the equity shareholder. So this bonus also be having the right of the equity shareholder. Okay, so the many discussion we are having, and one more thing that the equity shareholders are having the voting right. They can cast their vote in favor to select a candidate to forming the board of directors. Okay, they are having the right to interfere the company affairs. But these types of right, the preference shareholder should not have. Okay, now you move on. The next meaning is share capital. What is the share capital? You know that a share capital, the company can raise their share capital. The company can raise their capital by issuing the share. That is called as share capital. And the consolidated, the capital account has to be prepared, which is called as share capital account. And now we will move on the types of share capital. The types of share capital. So what are these? Number one, authorized capital. Authorized capital. Then number two, issued capital. Then number three, subscribed capital. Then number four, called up capital. Then number five, paid up capital. Then number six, reserve capital. And last one, capital reserve. So this is the types of share capital. Now we'll discuss one by one. First of all, we move on. Authorized capital. What do you mean by authorized capital? Authorized capital refers the authorization or the authorities is given to the company regarding the memorandum of a company that the company can maximize their share capital under the share authorized capital. So that means the authorized capital, it refers the memorandum of a company is given the authorized to the maximum amount of share capital is called as authorized capital. This authorized capital can be termed as registered capital as well as also termed as nominal capital. Then the next one is issued capital. The issued capital is a portion of authorized capital. That means how much the share the company can subscribe, how many the shares company can offer to the public for subscription. That is called as issued capital, and the rest of the remaining portion of the authorized capital is called as unissued capital, and the company can issue later on. And then we move on, subscribed capital. Subscribed capital is the portion of issued capital. Subscribed capital is the portion of issued capital. That means how much the shares the public subscribed or the public applied for it, that is called as subscribed capital. And the remaining portion of the issued capital is called as unissued capital. And this subscribed capital can be termed as subscribed and fully paid capital, and the second one is subscribed but not fully paid capital. Then you move on, the next one is called up capital. That means the called up capital is the portion of subscribed capital. That means how much the company can ask to the public. Like suppose the company offer 50,000 share and the value of each share say rupees 10. But the company asks to the shareholder to pay rupees 8. So that means the number of share whatever the public subscribe, it will be multiplied by 8 and the amount is called as called up capital. And the remaining portion whatever the company did not ask, the remaining rupees 2 is called as uncalled capital. Okay, and then you move on the paid up capital. So paid up capital is the portion of the called up capital. How much the public actually paid? Like suppose the company offered 50,000 share to the public for subscription, but the public offer just only 45,000 share. You know that the minimum 90% should be applied by the public. That is called as minimum subscription. Okay, and the public applied for like 45,000 share and the value of each share rupees 10. So the company, they are supposed to get 45,000 into 10, that is 4,50,000 as subscribed capital. But out of them, a shareholder who had 500 share who failed to pay the last installment, like suppose rupees 2. So how much he did not pay? 500 into 1, that is 1,000. So 4,50,000 the company they are supposed to get, and out of them a shareholder who had 500 share who did not pay last call rupees 2 per share. So that means 500 into 2, so 1,000 the company did not get out of 4,50,000. So the 4,49,000 is considered as paid up capital. Now you move on the then reserve capital. Reserve capital is the part of uncalled capital. So that means whatever the company did not ask to the shareholder to clear the uncalled capital, the company usually asks the shareholder to clear the uncalled capital at the time of liquidation of the company, at the time of close down of the company, to clear the outsider obligation, to meet the outsider commitment, so that the company can easily clear the outsider obligation with the help of the reserve capital. So the reserve capital is termed as the part of the uncalled capital. And now last one, the capital reserve. So the capital reserve is associated with the capital profit of the company. Okay, like the profit on forfeiture of share, profit on sale of asset, profit on sale of investment, these are considered as capital reserve. Okay, so I think that you have having some clear, or you don't have any problem to understand these things, the types of share, the meaning of share, okay, the meaning of capital, the meaning of share, the types of share and the types of share capital. Okay, so next time we'll discuss one by one again the rest of the topic. Thank you very much. Have a nice day. Thank you.